Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have a lot to discuss on the Econ Show, and so there's a lot of things moving right now. We have the dollar going up, we have yields moving around, we obviously have inflation going up again in the US, and we want to break it into our different parts as normal, but there's going to be some common thread behind it, and a lot of that is going to be rates and the US dollar, because as the dollar strengthens to the levels, especially that it's at right now, you get a lot of additional stress that hits emerging markets, that hits people or companies and countries that are relying on the dollar, whether that be for the petrodollar buying the oil and refined products, or just in terms of actually financing their debt. So there's a lot of things that we want to touch on. And we did a show on this back in 2020 about US dollar dynamics, which I think still holds true. And I will put that in the comment section just so people can go and look at it in terms of what are some of the things that we said about the dollar coming into really coming out of COVID or out of lockdown, in terms of where that's going to go and where we see that going from that point forward. And I think so far we've been pretty spot on. So the way we're going to break this up this time, we're going to do how the rising dollar impacts the world market, because we want to look at that at a global basis and really look in the different pieces and how the stress is going to grow at those different levels. Then in segment 2, we're going to talk about how inflation came in very hot, and how PPI, or the producer price index, topped estimates, and how that continues to be a leading indicator of where inflation is going. But we want to go through some of the different pieces, and then we're going to talk about the small business indexes and how that's looking on the small business side, and relating that back to jobs. Then in the segment 3, we're going to go deeper into real wages, how they're falling again, obviously as inflation goes up and wages actually start to come down a bit. That's obviously putting more pressure on the consumer. And then we're also going to talk a bit more about real estate. Now in the segment 4, we're going to talk about how the ECB is going to manage rates. And as of last night into this morning, there's also a issue within Italy, as the Five Star Party has said that they will not be backing Draghi, and he had said that if he didn't get everything together, that he would actually resign. So we're going to talk a bit about that in terms of how that could throw things off when you're looking at Italy and the EU, and how they were already in a tough spot, and this is only making it worse. And then when in segment 5, we're going to talk a lot about China and the issues that they're seeing again on the real estate side, with it actually getting much worse. But we want to look at, well, how is it getting worse? Where is the stress being pushed? And then we're going to go a little bit deeper into Korea, Japan, and India. But the focal point is really going to be Chinese data, Chinese real estate, because again, that is a big issue when you look at the second largest economy in the world. And with real estate being such a huge part of that GDP, there's a lot that could really reverberate through the global economy. So now as we shift over, we want to look at the broad US dollar versus global financial stress. So you can see here that as the dollar goes up, you're typically getting that financial stress index also rising with it. And the reason why is because so many things, whether that be global trade, whether that be rates, everything is tied to the dollar, either directly, indirectly, but there's a huge problem when you get not only just the move higher, but the speed in which it moved. And that's the biggest problem, is the rate of change is the one that hits the hardest. And if you just look at the chart to the right, that black and white one, you can see that we went from 90 to essentially 109. And it's pulled off a bit from 109, but it's gone up in just a straight line, and that creates a lot of stress. And then you have countries that have to manage this, because as the dollar gets stronger, there's inflation fears that will start to grow internally. And as those inflation fears start to ramp up, what do? They go to buy dollars to help solidify and backstop their currency, which is again also creating a self-fulfilling prophecy, because as they go out and buy more dollars to solidify and to backstop their assets, their currency, you inherently are driving up the price of the dollar because you're the one buying it. And if there continues to be more buyers than sellers, and we're going to go deeper into how in segment 2, how M2 is getting cut. QE is over. We're into quantitative tightening. So you have supply also coming down as you're having this demand still remaining strong and still trying to backstop the issues that are out there. Now, that's one side of it. The other side, a lot of debt was put into U.S. dollar denominated debt, and a huge component of it was done during 2013, 2014. You had the dollar that was fairly low. You had a lot of support there, and countries wanted to tap this chase for yield. So you had countries, sovereign as well as corporates, saying, look, I'm going to eliminate the biggest hurdle for investors, which is debt in my local currency that then they have to go do an interest rate swap. They have to protect themselves. I'm going to simplify it, and I'm going to issue my debt for local consumption, but in dollars, and eliminate the interest rate issue. And we saw that continue to progress well into 2015 until we started to see it slow a bit. So you have a lot of debt that is dollar denominated, which is fine when the dollar is stable, when the dollar is fairly cheap. But as it gets more expensive, it becomes harder and more costly to convert your local currency to dollars to pay the interest expense. But also the rate of change makes it harder, because if you're a corporate entity or a government, you're trying to have a budget, and the budget gets really hard to maintain when you have a parabolic move in dollar pricing, because all of a sudden you had factored X for interest expense, and within a 2-week period, it's now Y. And that becomes a very difficult thing and increases the stress. And that's where we continue to see some of these problems. Now, taking that a step further, and you look at distressed emerging market sovereigns. So when you look at the pressure points, and that you just have to look around the world, you look at Latin America, especially when you look at Central America, you look at Sri Lanka, you look at some of these other Asian nations, there continues to be protests and riots in terms of energy prices, food prices. So you're getting that distress already post-COVID, as we wrote would happen in March of 2021. We did that whole article about what happens post-COVID, when we start to reopen and inflation is rampant and all of these pressure grows. So obviously the distress is only getting worse. And so we talked about the dollar component and the dollar volatility, but bond volatility also makes this much worse, which is this MOVE index. And you're seeing it sit at the levels not seen obviously in 2020, but in 2020 it was a spike up and a quick fade, where when you look at 2008, 2009, you had continuous volatility which created a lot of uncertainty, a lot of fear. And when you look at 2022, we continue to have a lot of this uncertainty, a lot of this fear. And if you're a sovereign or a government that is looking to roll debt or issue new debt, well, the bond volatility is going to make investors say, "Look, you're going to have to give me a higher interest rate because there's so much uncertainty in the market. There's so much volatility in not only the dollar but also in rates. I demand a higher rate of return." And so that also increases cost. That also increases the uncertainty. And even with this movement, you'll also have companies say, "Look, I'm going to wait for things to settle. I'm pulling my debt offering, or I'm going to reduce my debt offering." And that also becomes an issue, because then you have CapEx slowing, you have corporate slowing, you have industrial slowing, manufacturing. And that knock-on effect continues as you have that kind of pullback. So then when you start looking at some of these stress or sovereign debt vulnerability, you get an idea of where some of the issues are continuing to arise. And it's of no surprise, inflation is a big driver of that when you start looking at obviously Kenya, Argentina, Pakistan, Ghana. there's a lot of uncertainty when you look at what can be vulnerable in terms of, what is stable. Obviously, Kuwait, Saudi Arabia, UAE, South Korea, things that have large economies that are, have obviously Kuwait, Saudi Arabia, UAE, making a lot of money from the oil side, South Korea, huge trade hub. So when you look at the different sides of the risk scale, Ghana, El Salvador, Pakistan, Egypt versus Saudi Arabia, Kuwait, you kind of get an idea on where the separation is. What is Pakistan's exports? How can they stabilize the economy? How can they stabilize inflation? And when you look at a lot of these countries in the top 10, they've taken IMF loans. So there was already issues prior to coming through into not only just COVID, but also post-COVID. And that's where you continue to get a lot of the stress. You continue to get a lot of these concerns. And these concerns also demand a higher premium. So if Kuwait comes to the market and says, I'm issuing debt, an investor is going to say, okay, well, you don't have a high debt load. You have a fairly stable cash flow income. I'm going to say, okay, well, I'm going to say, I'll give you money 200 basis points above the 10-year U.S. 10-year. So that's something that could be done. It could be higher. But then when you look at a Pakistan or an Egypt, you're like, wait, guys, what is the stability in your country? What are you looking for? And that's when you start to see the premiums blow out, which just makes it very difficult and more expensive for these countries to access capital and then at the same time manage their portfolios as the pressure continues to rise. And the pressure continues to rise on the central bank side. So more than 80 central banks have hiked rates this year, with more to come. We had South Korea taking it up again. There's now there was an expectation of a 1% increase or 100 basis point increase in the next Fed meeting. Now that's backed off a bit to 75 basis points again, with another one in September. But we'll talk about that more in a bit, because there's a lot of pressure coming in and there's a lot of these movements that are keeping, again, rates elevated, the pressure on the emerging markets, because they're also trying to manage their local inflation. And another way to do that is to raise rates. And as you raise rates, you increase the borrowing cost, you increase the pain, and that continues to reverberate in that system. But coming back to the cumulative central bank balance sheet, this is where you have it coming down. So the cumulative sum is looking at the Fed, ECB, Bank of England, Bank of Japan, and the Swiss National Bank, because as this comes down, you're getting this capital or this liquidity getting pulled out of the market. It's slow. It's not this massive drop, but it's also helping to support this dollar strength. The ECB, Europe is in a world of pain, as we've been saying, which is why we had made the call that the dollar would go to parity. And here we are now, we're through parity. And that's, again, going to push people more to the dollar versus the euro and the yen. But you're getting the shrinking pool, which is making it a bit more difficult. And all of this that we've discussed is making people adjust their portfolios. So it shouldn't be a surprise that everyone's looking at this and saying, all right, well, emerging market debt, I can try to backstop it, put an idea of where the value is, but emerging market equity, this is an unknown, and that's when you're starting to get the increase in liquidation and flight from emerging market equities. We expect to see emerging market debt also start to go down as that panic starts to pivot and you start to see some of these issues moving through. But up to this point, the global manufacturing PMI has been fairly flat. When you look at it on a world basis, it's just over 52, so still an expansion. But when you look at where some of the pain is right now, it's fairly low. There aren't a lot of emerging markets that are seeing manufacturing PMI that are in contraction. It's still an expansion. So when you look to this point, things have been okay and bumping along. As we've been saying, we expected it to maintain some growth, be in the expansionary period. But now, as you have dollar risk, as you have rates risk, as you have these pressure points, and as that CapEx starts to get cut, that's why we expect manufacturing PMI to really slow, especially at the emerging market level, as they try to manage where things are and where these different flows are adjusting. you also have the shift in what is onshoring versus nearshoring. So when you look at where some of the pivots are, and this is going to feed back into what we're going to talk about in China, you have a lot of industries that are looking to get closer to home. That could be onshoring back in the U.S. That could be nearshoring, and we've seen a lot of that start to show up in Mexico and some other areas around the U.S. as a way to get away from China, as a way to minimize the exposure. And we're going to talk about why that's starting to make economic sense outside of obviously supply chain issues, COVID issues. But that pivot is going to be a good thing for some of the local markets that feed directly into the U.S. And you can see that in terms of where are they originating from, it should be of no surprise that it is China. You're seeing China, Germany, Japan, Canada, Korea. So that's going to continue. But China's, as we said back in 2020 and realistically in 2019, you were going to start to see that swing because the cost benefit of moving from the U.S. to China was essentially taken to zero. And now you're starting to see that come back through. And you can see it's pretty much across a significant amount of industries, including transportation equipment, chemicals, machinery, computer and electronics. And there's also a little bit of that geopolitical in that when you start looking at computer and electronic products. The trade war, a lot of these tariffs and these concerns about Chinese expansion along that front has again also created a bit of a political hurdle to go from the U.S. into China. But one of the big things is China's lost the wage competitiveness. And we've always said that as people in a country get wealthier, they start to see their salaries go up, they start to become moving out of poverty into more of a middle class. They're going to demand higher wages, cleaner water, cleaner air, less crime. So you start to see the cost go up. And you can see here how it's continued to close that gap. Obviously, it's not back to zero, but when you look at the delta between the two in terms of the cost of closing the facility here, building a new one in China, hiring, ramping, all of a sudden that small benefit is just evaporates. Then you have the issue with appeasing the CCP in terms of making the contributions that need to be, hiring the people that need to be there to represent the government. It just becomes, well, what's the point? Like I'm not gaining anything from going there. And that's when you start to see the full cycle of globalization hit, where you maximize one area and then you continue to try to close some of these gaps, which is why we've said Vietnam and some other ASEAN nations were going to attract some of the competition or some of the industries that would have gone to China outside of the ones that are also coming back into the U.S. So when you look at the participation of developing countries in the global value chain is peaked. And this is what we've been talking about, like the global value chain is starting to maximize, and we just see it coming down a bit. Again, finding this natural balance as they're looking at not only logistics, because as we learned, logistics is very important, supply chain is very important. You don't want to have all your eggs in one basket, as we learned and as we've been saying for God knows how long. To be too levered to China would be dangerous, and this is where you're starting to get some of these shifts. And then when you look at the high-income countries trade far more with each other than with China, that is also going to get a bit worse as you get more onshoring, nearshoring. China is obviously going to be a huge part of the global supply chain. That is not going to stop. It's just they're not going to be as big as before, which is going to be a bigger problem because when you look at the Chinese GDP, exports used to be a massive component to the GDP calculation. It's still big. It's still 15 to 17%, but it's going down. And that's why local consumption, the consumer, which is, again, dual circulation strategy, common prosperity, is so important because they're trying to replicate, or I should say replace, what they're losing on the export side with the local consumption, which is becoming a huge problem. Now, another problem on top of this is inflation. And if you look at the G7 countries, you're looking at a lot of inflation. And as we've talked about, the developed market really drives the emerging market. Back to the comment on global manufacturing pressure increasing. this is where it originates, because as these countries feel pain, they spend less, they do less, they start to cut a lot of their orders, which then reverberates down. But it starts here and flows downward, which is why emerging market global manufacturing PMI was still in expansion. There's still some growth. It takes time to go all the way through, but when you look at what composes the inflation, obviously energy is there, food is there. We don't see either one of them getting much better. We do see them peaking on the energy and food side, but on everything else, there's a lot of movement, and we're going to talk about that in segment 2. There's broad price increases, and I know everybody likes to talk about energy and food and gasoline coming down, but it's hitting elsewhere. So even as this blue and yellow come down, you still have the other components, which again, leading to that stagflation, that global slowdown and global pressure. And just to look at the headline numbers in May, which as we know in June got worse again, obviously energy is a huge issue with when you look at what is happening in the global market. It's not getting much better. We talked in the EIA show about electricity pricing, about the coal, natural gas. We're going to go deeper on that in the FSC show. But again, these are things that are going to stay around. But when you're looking at it, all items continue to creep higher. That are those drivers of inflation. So even as energy pares back, you're still going to have a lot of staying power, which is why the OECD data in terms of consumer confidence across all of the OECD is the worst ever. Now, again, sentiment is different than actual spending, but one leads to the other. So sentiment came way down. Spending is going to come with it. We do expect sentiment to bounce a bit, especially as gasoline prices fall back, because typically sentiment is very closely tied to gasoline prices. So as gasoline prices get a bit better, sentiment will improve, not getting anywhere near back to normal, but that's where you're going to continue to see some of this pressure. But again, the spending is going to come down, again, not all the way down here to meet where sentiment is, but you're seeing the trend, and the trend. And based on how important the consumer is for global growth in a lot of these countries and global GDP, you get an idea of why we're so cautious on some of this growth. Federal Reserve Bank of New York Global Supply Chain Pressure Index coming back down. But even as it normalizes, you get an idea that you're still very abnormal. It's just not as bad as it was before. So this will help pricing. Excuse me. This will help pricing a bit. This will help some of these different pieces along the supply chain come down. But when you look at diesel, when you look at labor, that is that crux of why we see some of that, again, sticking up a little bit higher and leading more to that stagflation. So even as supply chain costs come down, some of the others, again, kind of match it on the downside, keeping things fairly fixed on a pricing component. And then when we look at PPI, as we will in the next segment, you get an idea on why there's that staying power in some of this supply chain, manufacturing, industrial side. So when you look at the declining trend in productivity growth, you get an idea of just it's been long term, and that's been the piece of offshoring. Getting that manufacturing is the local productivity has gone down because you've outsourced, and now as things start to onshore again and nearshore, we do expect to see some of this start to pivot back up. You're starting to get more investment in automation. And so we should actually see this reverse a bit, but it's still looking at measured as GDP per hour worked, and you're still going to be at a very low level. So it's going to take time to see this provide some sort of uplift to GDP. All the while, when you look at the U.S., the 10-year, 2-year government bond spread inverted, which is the warning sign of a recession. So, but our view is that as a recession gets priced in, then inflation expectations going further out have actually gotten much lower. So that also put pressure on the 10-year. So you had the 10-year rate coming down, 2-year rate going in terms of just the fear in general. So as the 10-year rate came down, that's where you started to get some of this pressure. But as inflation, I think, starts to get priced back up, that's when you'll see the steepener again, and you'll see the 10-year going back up, going back to the highs. So then when you start looking at U.S. high yield credit spreads and default rates, as spreads go back up, it usually results in a higher default rate. But we look at the U.S. high yield because if it's happening here, it's only going to get worse abroad, especially when you start looking at the FX volatility indicator, which is going back to the highs that we saw during the British exit, obviously 2020 with COVID. But when you look at just that staying power in the volatility index, those defaults, that's where you continue to get this fear and that flight to safety. So then when you look at past Chinese weakness is going to linger, you just look at Chinese import volumes, which continue to fall, which continue to move lower. And we're going to talk about this more in segment 5, but it leads to more pressure. Euro USD, when you're looking at Euro Yuan, there's a lot of this pressure in terms of what is flowing from the U.S. into China, from Europe into China. And again, that's that kind of back and forth in terms of just global trade, notwithstanding this recession and actually coming down, which we're going to talk about in segment 5 with the Korean leading indicators. So now when you look at private sector credit flow, you can see that it's moving firmly negative, and it just comes to private credit impulses. So if you have credit impulses going negative, it means you continue to have this contraction, you continue to have this pressure coming down, which is going to put pressure on economies, their ability to grow, their ability to invest. And it's happening at the top level. And as that increases, as that pressure remains, that again flows down to the emerging markets and puts pressure on just how can they go out and try to borrow and grow their economy. But one of the big pieces that we've talked about is that aging the global aging phenomenon. And you continue to see people get the populations are getting older. And as they get older, they start to retire. They start to become obviously less productive because they're not working. And as you can see, China has a huge problem with that. And obviously every country has their own issue, but China's is accelerating at a rapid pace. And that's where you start to see other pressures that are more longer term. And this is not this is a structural problem. And it's cyclical in its own right. But you're talking about something that is measured in centuries, not just even a decade. Because if you think about raising a child, the speed in which you can raise it, the child gets older. There's only so much that can be done to adjust it. And one way to do it quickly is immigration, but China has very tight immigration rules. They are not very friendly to immigrants coming through. So it's going to be very difficult for China to right this ship because as the population ages, it puts stress on governments. It reduces the productivity. It essentially is an anchor on economic growth, which is something that is going to only get worse and let's call it a heavier anchor for China as it pulls down. So then when you look at the CPI forecast, continues to rise above policy rates, which is why we continue to see rates going up and why we think that there's going to be additional pressure, especially given the dollar growth, rates going up. That's going to keep a lot of these emerging market CPI forecasts moving up. And in response, their central bank rates also going higher. Now, the export exposure to Europe among emerging market sovereigns is very high. Not surprising. It's a lot of emerging Europe. And as they continue to struggle, again, this is that blowdown. When you look at who is going to be impacted the most, this gives you an idea of where or who is going to get hit the hardest. And as they see their trade slow, it's going to weigh on GDP growth within that local country, Eastern Europe, and a lot of other parts of emerging Europe areas. Consumer price inflation expectations. Markets are still pricing inflation to converge towards 2%, but they're also expecting it to happen very fast. So the chart shows market implied expected inflation for 23 to 24 at less than 4%, 25 to 26 less than 2.5%, and 25 to 27 2.3%. So the sustained inflation of over 3% is not the consensus. And we just think that's wrong. And when you look at the underlying, when you look at the supply chain issues, when you look at the shortages on the commodity side, We do think you get a deflationary cycle, but we don't see this inflation going away quickly. Instead, it's going to stick around longer. Again, it could adjust if the Fed or if central banks continue to raise rates very quickly, try to get aggressive, but we don't think they'll be as aggressive as they should be, similar to what we saw in the 70s. As so far, it feels as though we've made every error, the same errors as we did in the 70s. We're doing it all over again. We just have to have a few price controls, and we're right there. So again, that's why I think we do have inflation that's going to be sticky, that's going to be problematic. We have said for the last decade, inflation has been rampant, but they've been hiding it by increasing, by trying to play with the velocity of money. And when you look at the velocity of money, even as GDP growth flatlines and actually starts to depress, but the denominator, which is the money growth or money availability, as that goes up, you bring down the velocity of money. So it looks like things are good, inflation is low, but realistically, it was just hiding the fact that it was always there. If you look at the way people were spending on healthcare, on housing, on childcare, on education in general, you can see that there was a lot of inflation that was just beneath the surface, and this COVID spending spree just ripped the Band-Aid off, and now it's hard to bury it again. So debt decrease, companies' debt load falls as new bond supply falters. Again, as supply is faltering back to because of volatility, bond volatility, dollar volatility, people are just moving and stepping to the sidelines. And then when you now shift over to grains, here you can see that the grains prices have gone back up. So as we've been saying, we expect it to be volatile. We didn't expect it to stay at these all-time highs, but because of the shortfalls, because of the issues in the market, we do expect to see a lot of support in the ag space. With fertilizers, round trip for fertilizer prices since Ukraine war started. Russia's invasion was an accelerator of prices, but it was never going to stay at that level, those extremes, because countries are going to find workarounds, but it doesn't mean we're going back to normal. And you could say normal as of 2019, we're just going to stay at these very elevated levels, and we're just back to that spike, which we saw prior to Russia, prior to the Russian invasion. There's a lot of staying power on the fertilizer front at these levels, which is where we think it's going to stay and will be supportive of some of the fundamentals of the underlying companies. Now, the global food price fell again in June. Food and agriculture index in level terms, prices are still astronomical, but the trend is stabilized. And again, we don't see it going up much more, but we also don't see it coming down much more, again, leading to what we've talked about with the stagflationary backdrop. And now rounding it out with world wheat stockpiles, you can see that they are at the lowest level they've been since 2015. So the international wheat and maize markets are expected to stay tight, which means prices will remain volatile and continue to be highly sensitive to daily news on crop development, weather conditions, policy changes. But it's still going to stay elevated because all of the storage, all of the stockpiles, all of the yields are moving in the wrong direction. And if you think about commodities, again, priced in dollars, as dollars go up, it's inherently getting more expensive for countries to buy food. And again, putting more pressure on an already dire situation. So I know this was a long one, but there was a lot to cover, a lot of things that we wanted to go through. So in the next segment, we're going to go deeper into U.S. inflation, how things are shifting, and where do we really start to see inflation moderating.